and activities in promoting a stable and efficient financial system. As a member of the bank's governing council, she shares responsibility for decisions with respect to monetary policy and financial system stability and for setting the strategic direction for the bank. Prior to her appointment, Ms. Patterson was Special Advisor to the Governor and Senior Representative at the bank's regional office in Toronto. Ms. Patterson has had a long and distinguished career in the world of finance, including President and Country Head of America Merrill Lynch Canada, National Sales Manager of Fixed Income at Goldman Sachs Canada, and Fixed Income Portfolio Manager of the Ontario Teachers Pension Plan Board. She also held various trading positions with JP Morgan Canada and CIBC Wood Gundy. Ms. Patterson has served on the Government of Ontario's Economic Advisory Panel and is a recipient of the Diamond Jubilee Medal as a builder and innovator in Canada's investment industry. Please join me in welcoming Lynn Patterson.
Just get organized here. Thanks, Cheryl, and good afternoon. So I guess I don't need for this audience to tell you what my speech topic is today, but for the benefit of those that are maybe watching the webcast, I'm going to speak about interest rate benchmarks and the work that's going on both here in Canada and globally to strengthen them. And before I start, I just want to say I'm really glad to see so many different people from the industry here, because these changes are really going to impact everyone. So before I dive in, I'd like to take you back to the 1980s. And I can also tell by scanning this crowd that that is a decade that might be more familiar to some of us than to others. So aside from the monstrous shoulder pads that were in my suit jackets, the 80s gave us several important innovations. And one of the most widely used is Windows. And not the kind of Windows that you have in your house, of course, but the operating system for your computer. Microsoft released Windows 1.0 in 1985. Most of us are now using Windows 10. And with each new version, we've been given improved functionality and reliability. Now, the most widely used benchmark, the London Interbank Offered Rate, known as LIBOR, was published 1 year later in 1986. In contrast, LIBOR has had one material change in the last 30 years and was certainly not originally designed to support what is now a $350 trillion market. Yet it's difficult for us to imagine modern financial markets without derivatives that are enabled by benchmarks. Just as Windows 1.0 wasn't versatile enough to support new computer programs that have been introduced over the past 30 years, many benchmarks are no longer suitable for the wide array of derivative markets that they support. In addition, the scandals and mistrust related to the manipulation of benchmark rates for the financial benefit of individuals and institutions have made their future use unpalatable. Now, for many of you in this room, you understand the important role that benchmarks play in the functioning of markets. And like Windows, how they function and how they may change matters a great deal to not just your industry, but to all Canadians. Our financial wealth is linked to benchmarks. For example, exchange-traded funds and mutual funds may invest in products that are linked to them. And mortgage costs are derived from a number of inputs, some of which use benchmark rates to determine the rate at which you will borrow from your mortgage lender. So improving this foundational element of the financial infrastructure is critical, both for the financial industry and for the broader economy. Indeed, we're long overdue for an upgrade. So in my remarks today, I'm going to discuss the work afoot to either validate, enhance, or transform various widely used benchmarks or to create new ones. And so as I begin, I'd like to thank our two sponsors, the Investment Industry Association of Canada and the Institute of International Finance, for hosting this event. So let me start by explaining the role of the Bank of Canada in benchmark reform. Aside from setting monetary policy to meet our inflation target, our mandate is to foster the stability and efficiency of the financial system. Benchmarks contribute to this efficient functioning of markets and the stability of the system. Getting them right matters. Now, the Bank of Canada is playing a role in these changes through our active membership in the Financial Stability Board, or FSB, and they're leading the global effort to coordinate benchmark reform. Central banks are trusted, and they keep a watchful eye on risks to financial stability, so it's important that we're involved in this work. Now, since 2014, a number of major upgrades have taken place, and they've been guided by a set of principles that were set out by IOSCO and also FSB recommended improvements to LIBOR and other benchmarks. And with these improvements, the FSB is also urging countries to develop new benchmarks that are based on short-term, risk-free, observable rates, or if they do already exist, to promote a more active use of them. So we have market participants together with central banks and other authorities that have been pursuing this twin-track approach, strengthening existing benchmarks while also developing alternatives. Now, a risk-free rate would accomplish a number of goals. First, it would reduce the reliance and independence on any individual benchmark. And second, it would allow counterparties to select benchmarks that might more closely match the exposures that they want, thus better meeting the needs of some of the derivative markets. So let me run through a little example to bring this point home. So LIBOR is meant to represent a bank's cost of funding, and it can vary due to a number of factors, including an increase or change in the underlying rate, or a deterioration in the creditworthiness of banks, as we saw during the global financial crisis. So imagine a sovereign issuer that's wanting to take a fixed rate or a term bond and swap that to a floating rate liability. Since that issuer's creditworthiness doesn't really fluctuate with that of the banking system, using a benchmark with a short-term rate that is not influenced by the creditworthiness of banks would be more appropriate. Some of the alternatives that have been identified so far are new, and others are existing rates that have been or are being enhanced. But in all cases, they are overnight rates. At this point in time, many regions are now exploring whether to develop term risk-free benchmarks, say for either 1 or 3-month maturities. And this might help the transition from LIBOR-type benchmarks to where term rates are more widely used than overnight rates. So the pace of all of this work accelerated last summer thanks to Andrew Bailey, the chief executive of the UK's Financial Conduct Authority, which regulates LIBOR. He announced that LIBOR could be sustainable until the end of 2021. After that date, the FCA will not persuade or compel banks to submit LIBOR rates. So this means that markets and organizations here in Canada like yours need to be ready to transition to alternative benchmarks. Now, initially, this came as a little bit of a surprise to some people in the markets that haven't been following benchmark developments as closely. But here we are, roughly 12 months later, and there appears to be wider market acceptance of what needs to be done, and progress is continuing despite the significant complexities. So let me now turn to the U.S., and I'm going to focus on recent developments there, as the U.S. dollar LIBOR is the most widely used of the existing benchmarks, and Canadian investors and issuers have material exposure to it. So consider the sheer size of the market that references it. In 2016, notional contracts priced off of LIBOR totaled nearly $200 trillion. Now, the lion's share of that exposure, around 95%, is in derivatives and primarily interest rate swaps. And then there's another $8 trillion that are in cash products, everything from floating rate notes to consumer loans. So the work to develop an alternative to LIBOR in the U.S. is being led by the Alternative Reference Rate Committee, which is known as ARC. Now, ARC is composed of dealers and asset managers, issuers, exchanges, as well as regulators and official institutions. And this past April, the New York Federal Reserve System began to publish the Secured Overnight Financing Rate, which is known as SOFR. And this has been selected as a reliable benchmark for new U.S. dollar derivatives. Now, as I mentioned earlier, like some other rates internationally, SOFR is an overnight rate, and it's based on the Treasury repo market. So it's covering multiple segments of that market, including tri-party repo, dealer-to-dealer, as well as centrally cleared bilateral repo trades. It's based on around $800 billion in daily transactions, and it adheres closely to the standards that were set out by IOSCO. So now, to establish SOFR as a widely used benchmark, an entire ecosystem of products needs to be built around it to encourage trading and to generate liquidity in SOFR-related products. And this work has also begun. Futures contracts for SOFR began trading in May. All of the primary dealers have pledged to support that market. And so far trading's been relatively light, but it is expected to increase as more market participants revamp their systems. And sometime this summer, overnight index swaps that reference SOFR will begin trading, and they will be accepted for clearing through central counterparties by later this year. So now, of course, greater market adoption will require the involvement of the buy side. The engagement of asset managers and issuers alike is critical. And the next step may be the identification of a term rate that is based on SOFR. And it's possible that this could be developed through the futures market. Now, many trade groups are collaborating in this work. It goes well beyond just selecting a new benchmark and developing markets that reference it. For an example, an important transition element is fallback provisions. And this is a contingency that's written into financial contracts in case your current benchmark is no longer viable. Now, contingency plans or fallbacks are a feature of many things that we all consume in life, whether it's a backup electrical generator for when the power goes out or a new car vendor guaranteeing you a rental if you need to get your car fixed. So, given the uncertainty around the existence of LIBOR after 2021, it just makes sense to have appropriate fallback provisions that are written into financial market contracts to allow these products to transition smoothly to the new benchmarks. Now, although considerable progress has been made in the U.S., reform still has a long way to go. And as William Dudley, president of the Federal Reserve Bank of New York, emphasized in a recent speech, we have a compressed time frame to get the work done, so we need aggressive action to move to a more durable and resilient benchmark regime. So let me now turn to Canada's benchmarks. In 2014, my colleague Timothy Lane gave a speech on benchmark reform, and it highlighted the work that was being done here and the rationale for it proceeding at a different pace than some of our global peers. And this is partially due to differences between our main benchmark, CDOR, the Canadian dollar offered rate, and LIBOR. CDOR is used for derivatives, floating rate notes, and loans, and at the end of 2017, it was referenced by more than $13 trillion of financial instruments. Like LIBOR, CDOR is based on submissions from a panel of banks, but there are major differences between the two rates. So just as a reminder, LIBOR is a borrowing rate, and it's based on estimates of unsecured transactions between banks. Now, we've seen this volume decline, which means that LIBOR has become more reliant on the judgment of experts rather than on actual transactions. In contrast, CDOR is a lending rate, and it was actually originally developed by the banks themselves to facilitate the calculation of a benchmark rate for the Bankers' Acceptance, or BA, market here in Canada. Now, BAs have been continuously growing, and today they make up the largest portion of money market instruments that are issued by non-government entities. They account for around 25% of the total money market. In 2017, an average of about $76 billion in BAs was outstanding. We're publishing a paper today that discusses the evolution of the BA market. So since 2014, and in keeping with the IOSCO principles, CDOR has been strengthened in a number of ways. Thomson Reuters has been appointed as the administrator, and in that role is carrying out several related responsibilities. And the Office of the Superintendent of Financial Institutions is now supervising the governance and risk controls that surround the submission processes of the panel banks. So while CDOR does not have the same vulnerabilities as LIBOR, it is being used in derivative markets where the notional value of contracts is a multiple of the volume in the underlying BA markets, and where a risk-free rate may better suit the needs of many users. Now, in Canada, we do already have a risk-free overnight rate. Let me introduce you to CORA, the Canadian Overnight Repo Rate Average. Now, CORA measures the average cost of overnight collateralized funding, and it's an important reference rate for overnight index swaps, which investors will use, for example, if they want to hedge interest rate risk against Bank of Canada rate decisions. CORA is based on actual transactions, and it's calculated from on-screen trades through interdealer brokers. As with CDOR, CORA is now administered by Thomson Reuters. So in Canada, we do have a different starting point, and we've made further enhancements to comply with the IOSCO principles. But should we be satisfied that this is enough? And will CDOR remain the primary interest rate benchmark? Well, those are two good questions that I cannot answer for you today. But we've recently set up and work through the issues the Canadian Alternative Reference Rate Working Group that's known as CAR. So if you haven't caught on by now, you're not allowed to do benchmark reform unless you have a number of acronyms, okay? Just a side note. So we know that a risk-free rate is a better fit for most derivative-related exposures. And if other currencies are moving primarily to using risk-free term rates as their benchmark, then you as market participants may want to have that same option in Canadian dollars. So this CAR committee is co-chaired by the bank and by a private sector participant. And so aside from the body of work to explore this risk-free rate, it will also look at potential enhancements to CORA. And some of those could be whether a wider range of transactions could be used to calculate it. And this might include, for example, dealer-to-client trades. So we do expect that CAR may have a recommendation to bring forward on that potential enhancement by the end of this year. So from the outset, we wanted a diverse group to participate in CAR, people that were active in the marketplace with deep expertise. We now have 21 members, and I can see a few of you sitting in this room. Thank you for participating. And you come from banks and pension funds and investment firms. And because of the importance of ancillary products and exchanges where transactions are cleared, the Canadian Derivatives Clearing Corporation, the London Clearing House, and the Montreal Exchange sit on the committee as observers. So we believe that this is giving us a full perspective on the market, and the working group is currently meeting monthly. So while this committee is on the front line, so to speak, we need even deeper connectivity. And so the plan is to set up targeted roundtable discussions and other subgroups to solicit broader input. The issues we will be exploring are going to range from understanding all the types of products today that are using interest rate benchmarks and improvements that may be needed in fallback language for Canadian cash products that reference CDOR. So all of this work will give us a deeper appreciation of the impact of any future changes. So the demands will be high over the balance of this year and next as we assess appropriate options for Canada while keeping informed of international developments. And during this period, we will be sharing our findings regularly. Now, if a new risk-free term benchmark is developed, market adoption will be critical. And for that to happen, we will need all of you, whether you're pension funds, asset managers, banks, infrastructure providers, to use it. And just as functionality in each Windows upgrade prompts the development of new apps, a new benchmark will gain broader acceptance with the development of ancillary products such as futures. So let me now turn to the challenges ahead. First, like our economy, where cross-border trade plays an important role, there is a large volume of cross-border financial flows, which is critical to the financial system. So we have to work in lockstep with authorities elsewhere. Many cross-currency products reference benchmarks like LIBOR and CDOR. How quickly can markets for them adapt to using these new benchmarks or curves that are based off of them? And if some benchmarks survive and others don't, will there need to be common approaches that govern the use of interest rate benchmarks in foreign exchange markets? Second, there are also major issues around transition. Many contracts using benchmarks expire relatively quickly, but some are struck with much longer maturities. And for those, the transition could be much more complicated as the nature of those underlying exposures might change. And lastly, there are the challenges that we all face within our own organizations. Transitioning to new benchmarks means adapting trading and risk systems and back office processes, and we all know how long system changes can take. So this means we're going to need to start this work relatively soon, or as soon as we know what reference rate we will be utilizing in the future. And as we begin to trade these products, we will also need to be patient because it may take some time for liquidity to build up. So, in sum, you've heard that the work underway on benchmarks is complex and requires a great deal of coordination among countries, central banks, and users like you. And, like many of you, the Bank of Canada is committing significant resources to this effort. As I've mentioned, the stability of financial markets is an important part of our mandate, and benchmarks play a key role in the efficient functioning of markets. So my goal today was to try to help get us at least all on the same page and to help you start to think about readiness within your own organizations. That 2021 LIBOR deadline isn't really that far away. So I realize I may be giving you more work to do, but keeping up on these developments and ensuring that you are operationally ready is important. We've put together a website where you can follow our work, and as we will put postings up there from all of our monthly meetings. And I hope for those of you that aren't already involved that you'll participate in some of our subgroups and comment on our work. So reference rate reform is a necessary and huge global undertaking. Getting this right is critical for maintaining the trust and reliability in the financial system. While we certainly don't anticipate the need to reform benchmarks as frequently as Windows is updated, we are clearly in need of new versions. Ongoing monitoring by regulators, central banks, and market participants alike will ensure that this cornerstone of our financial market infrastructure can remain robust and resilient for years to come. Thank you very much, and I'd be happy to take a few questions on my topic.
Ladies and gentlemen, my name is Ung Tran, representing the Institute of International Finance, IIF, and allow me, on your behalf, to thank again Deputy Governor Patterson for an excellent speech, very informative, and even a subject as technical as reference rate replacement is coming alive. And thank you very much for that. My honor today is to moderate the Q&A session. And as you are aware, you should write out your question on the cue cards. It will be collected. And I have the honor of selecting the one that I think is interesting to ask the Deputy Governor. So to begin with, the first one, you mentioned a few acronyms in terms of potential options and replacement of the Canadian dollar's reference rate. Do you have a preference? Do you have any view as to which one, in your view, should be the one that replaced the current LIBOR rates?
Okay, thank you. At this point in time, I think the committee, the CAR committee was first struck and had one of their first meetings earlier this spring. So there's been 3 or 4 meetings thus far. I think 3, and there's another one scheduled next week. So I think it's a little bit premature to make any declarations, but it's really, I think, fulsome to see the body of work that all the subcommittees that have been created are currently working on. So there's a subcommittee that's focusing on CORA itself and thinking about enhancements, as I mentioned in the speech, whether that might come from adding more trade so that you've got a greater volume of liquidity. As you think about resiliency, you want something that's observable. And so that's one big piece of work that's happening right now. Another subcommittee is working on just kind of wrapping our hands around how much exposure is there across products to CDOR. And so I think that's really helpful. And then the next phase of that, we'll start to think about that terming out of the overnight rate, possibly, if it's a CORA decision to keep. And then lastly, a recent subcommittee that's been put together is to tackle this issue of fallback provisions here in Canada as well. And so I think I would hope, you know, I won't put the committee on the spot, but there's a few milestones by the end of the year that they're hoping to have in place. And again, I think, you know, this space is very fluid right now. There's a lot of things moving internationally, as you would know. And so we need to move our own work forward at the same time as being cognizant of what might be happening in some of the other regions.
Right. Talking about transition and fallback position and provisions. For derivative contracts, particularly centrally cleared or even OTC, it can be approached by changing the master agreement and so on, particularly ISDA. But for cash contracts between borrowers, consumers, and lending institutions, it's much more complex legally. So does Canada intend to have any kind of mandate, legal mandate, to allow private sector participants, both borrowers and lenders, to make this transition more manageable? Otherwise, it will be very difficult.
Right. Yeah, I mean, I think in time, you know, whether it's through trade organizations, generally, whether the bank helps to navigate that space, whether, you know, ISDA's been very involved in some regions, you know, we're going to need a lot of coordination with respect to what that might look like in the cash products. I think, you know, an important first step for everyone to think about is really, you know, to what degree are you exposed? It's interesting, in speaking to some asset managers on a recent trip that I had, they said we don't do derivatives, so we don't have any exposure, and, you know, but they've got a big floating rate note portfolio. So I think it's just important to at least recognize and understand your own exposures, and then start to think through how we will transition over time.
Yes. Also, you mentioned the need to coordinate with internationally to get the transition right. And here I have in mind 2 kind of coordination. One is to make sure that the replacement reference rate in different currency, different countries are comparable in nature. At the moment, it is not. If you look at the list of replacement proposals by different countries, most are collateralized rate using repo rates on government securities. But some are still using non-collateralized lending and borrowing rate. So right away you have discrepancy between the family of different rates. And secondly, the roll out, the transition, should there be some coordinated time frame? Should there be a big bang transition on end of 2021, everything move to the new rates, or a phase-in period? So what is your view on that?
Right. So I think on the different rates, I mean, the FSB is trying to coordinate this group. There's an official sector steering group of which the Bank of Canada has a couple of members. They're meeting more regularly as time goes on. I think to your exact point, it's very complicated. And, you know, we need to have some consistency if people are looking at cross-border trade. So I can't get too far ahead of what that might look like, whether we'd have a big bang type of date. You know, again, I think the FSB in this role of trying to coordinate this globally, it will really drive a lot of the dialogue around that. You know, my sense from my seat is that there's a very high degree of engagement by all the central banks to work on this together, and it's a very significant work. We've had a lot of speeches as of late. There is the need for probably excessive communication, so we're going to try to be very open with respect to our website and posting all of our meeting minutes. I know that we've already had a significant amount of interaction with officials in the U.S. to think about how we help to spread the word about what's happening with LIBOR across the various constituents in Canada. So, you know, again, I think there'll be an acceleration of that activity over the coming couple of years, probably.
And one question just coming up from the floor, which I think is very interesting. In your opinion, is there any international examples of a successful transition migration from one reference rate or one benchmark to a new benchmark that one can learn from?
Not on the top of my mind, but I would say, I mean, what we have seen is successful transition in some other forms post-crisis, whether it be other regulatory reforms for the banking system, et cetera. So I think there's been a heightened need as well as a heightened desire by the official sector and by central banks globally to work together on these things when it needs to happen in lockstep. And so this may be the same type of example. I mean, you know, I would say that we're starting to hear more and more, really, you know, a shift in a benchmark, it really is, you know, if it's you build it, will they come type of mentality. And so, you know, we're seeing in the SOFR market, I talked about futures, I talked about OAS, you've got to build up that underlying volume to then get that establishment. And we're seeing that as well in the UK with the SONIA rate. And I think there was an issue today that was based off of SONIA. So we're getting more market adoption, and that's what we'll need to feed the transition.
Right. And following on that, ICE, the Intercontinental Exchange, which is administrating LIBOR at the moment, in the past few quarters and months, try very hard to improve the methodology to calculate LIBOR to kind of rehabilitate it. Right. And so they come out with the waterfall methodology to make the calculation of LIBOR more transparent, more robust, and more trustworthy. Can you envision a situation where after 2021, even if the FCA will not use their influence to compel banks to submit, but if banks and other private sector entities continue to derive and contribute to LIBOR, can you imagine coexistence between the legacy rate, the LIBOR, and then the new rates?
I mean, I think it's possible that we can have multiple rates, but I think, you know, part of my objective in this speech was to really have you think about the fact that in many cases, if you're doing derivative products, you really don't need, or you may not want that credit piece. You're really just trying to transform what is an exposure from either a long-term to a shorter term. You want to change the tenor of your underlying exposure. You're not necessarily looking to add or subtract credit risk. So I think, you know, the one point is clear, is that there isn't a one-size-fits-all derivative that makes sense for every type of transaction. So, you know, is it possible in time to have a CDOR or a LIBOR or something coexist with another type of benchmark that services different market needs? I mean, at this point in time, in 2018, I'm going to say that's possible, but, you know, maybe I'll have a different answer 12 months from now.
Well, the reason for my picking that question, because it is one of the observations that I will make later on, in the sense that, yes, risk-free reference rates has a huge role to play. There's a need for that, but perhaps that role has been filled by the government securities rate, you know, treasury bills and treasury notes and treasury bonds. Already it's a risk-free rate. But nevertheless, risk-free reference rate is important, should be there. However, a reference rate with a credit element embedded in it is also important, because it more truly reflects the financial conditions and borrowing costs to private sector borrowers, either banks or financial institutions. And many market participants use that rate for hedging and also for reference rates to price securities, because you cannot rely on the risk-free rate alone. For example, in the US, SOFR, when it has been calculated, Oliver Wyman went back to 2000 until now. So SOFR, proxy by the repo rate in the US Treasury repo markets, tend to be higher than LIBOR on average over the past 18 years by 46 basis points on average, sometimes as wide as 460 basis points. So the credit element vary a lot. So that introduced another issue of comparability.
Yeah.
What is your?
Well, I mean, I do see the need for a credit component depending on what type of business you're in and if you're looking to borrow. So whether that can be accomplished through some other products in time, whether that be through the CDS market or what have you, you know, I think it's all at this stage of development. If you think about the last 12 months, I think we've actually made a fair amount of progress internationally. Certainly the focus now is taking what are some overnight risk-free rates and challenging that into a term type environment. And then, you know, certainly another piece is whether you have a separate benchmark, like I know there's been some efforts in the US within the smaller banking community to come up with something that can work, that has a credit piece that more replicates what LIBOR would have looked like before. So I think it's possible, and I absolutely appreciate the need for it in the economy.
So the very last question, and then we understand that you have a press conference that you have to attend. Yeah. For private sector financial institutions, what is your advice and message to us at this point? What should we do more to be prepared for this changeover?
Well, I think the first thing is you came to lunch, which is awesome. Hopefully it was good. But also you just have a better awareness of the topic. Secondly, as I mentioned a few minutes ago, I think really, you know, scrubbing your book, so to speak, and understanding where your exposures are. And then I think, you know, helping us. I mean, look, we put this committee together with as broad reach across the country, types of users as we could. Having said that, we know and we want to have some very detailed subgroup meetings, you know, whether that be specific to issuers or other members of the financial community, to ensure that we're getting a fulsome picture of what all the issues are. And, you know, I think it's, you know, we'll see how quickly things accelerate in the U.S. If you have LIBOR exposures, then I think it's important to understand whether or not you need fallback language. And there's some trade organizations that are very focused on that right now. So I think it's going to iterate and change over time as we answer some of the questions and make some decisions. But we certainly, you know, throughout our process want to come up with recommendations, and then we'll put them out for consultation. So please engage in that process with us, and we'll be working hard on our communications. Okay? Thank you.